This episode of the Altco's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is here. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and fighting.
We're going mainstream.
Welcome back to the Altco's Mainstream podcast. Today's episode dives into how operations and streamlining technology processes can be turned into a strategic advantage. We sat down with Arcesium's MD and Head of Client and Partner Development, David Nable, to discuss how technology is impacting how funds manage their processes, operations, and data. David was an early employee at Arcesium, helping the firm scale and working with many of the industry's largest asset managers across the lifecycle of an investment. David joined Arcesium after a career in fund services and fund administration that spanned senior roles at Goldman Sachs, Credit Suisse, and BNP Paribas Securities Services. David and I had a fascinating conversation. We covered how David's background in prime brokerage and fund admin helped him approach the technology problems for asset managers, how asset managers should approach where and how technology can be a strategic advantage, what does it mean to be a tech-forward asset manager, how does the growth of evergreen funds impact how firms manage their data and serve investors, and what still needs to be built to continue to improve private markets market infrastructure. Thanks, David, for coming on the Altco's Mainstream podcast to share your expertise and wisdom on private markets technology and post-investment processes.
In a collision of culture and fighting.
We're going mainstream.
David, welcome to the Altco's Mainstream podcast.
Thank you. Great to be here.
Pleasure to have you. I think we have such an interesting conversation on tap because technology is very much at the core of an asset manager's business. How they operate is becoming more important as the industry evolves, as new product structures get created, as that stresses the system and the entire life cycle of an investment. So I want to get to all that, but first, I think your background is fascinating as it relates to what you're doing today at Arcesium. So we'd love to start there.
Yeah, for sure. I got my start in the industry actually working at Lehman Brothers in the back office of the back office, learning the nuts and bolts. Moved over to Goldman Sachs. I was there for about a decade, working primarily in their prime brokerage businesses, their fund administration business. Fantastic experience. Really allowed me to build a bottoms-up, nuts and bolts understanding of what's going on. A lot of people ask me, how is that relevant to what you're doing today, and how have you sort of shaped that into the types of work? I think a lot about that. I'm a runner. I do a lot of endurance sports. There's a lot of parallels to how I started my career to running, in that a lot of people look at it as you're out there for long periods of time. It's boring. Some might say it's monotonous. But for the people that love it, it's actually quite meditative. And it allows you to really, while you're getting into the flow, whether it's running or reconciling trade breaks or investigating bank balance differences, you start to really get into a zone and you get to understand these nuances. And when you're running, maybe you start to notice where the hill gradually goes up or down, something you would never notice if you're in a car. But when you're on your feet there experiencing it, you start to, ooh, there's some camber in the road. Or when you're working in operations, noticing things start to look different. I'll never forget the first time I got in a FedEx and I opened it. It was a stock certificate with a stamp on it. I'm like, what is this? Well, it's a public investment in a private equity, a PIPE. I'm like, what do I do with this thing? This doesn't look like the stock that I would see on a screen. And so you start to see all these things. And months later, we started getting more and more of these FedEx. It's like, oh, there's a trend. This is going on. Our hedge fund managers are starting to creep into private investments. Now that trend has, continued, but if you are living and breathing in the detail, you start to pay attention. Now, I think it's shameful when people, regardless of what they're doing, they miss the beauty and nuance of those types of details. When you're doing something, you can approach it as being monotonous, or you can approach it as meditative and really pay attention and be present in what's going on and try to tie it to a broader story. It really allowed me a front seat to see as our clients were doing similar things. They were public managers getting into private investments, private equity managers getting into private credit, credit managers launching private credit strategies, and creating all of these really clever new structures and strategies and ways of combining things. And that really never stops. We continue to see it today with retailization of private strategies. And you'll see that both in terms of the types of investments that the major houses are doing, the types of investors they're pursuing. It's really been an interesting journey, and we're nowhere near done.
When did your feet start to change under you as you thought about how the industry was changing and evolving? Was there something or a point in time where you thought, wow, like private markets is really changing and the infrastructure required to facilitate that change really needs to take a step function, move upward?
I think about it as a continuum. I wish I could say there was, one. There's oftentimes an industry where there truly is an inflection point, a global financial crisis, Bernie Madoff, things that truly change how the industry operates and fundamentally changes things. There's no obvious point to me in private markets where something just fundamentally changed. It really has been a journey of looking at risk-adjusted returns, looking at the democratization of the asset class to bring it to a wider group of investors. It's really been remarkable to see sort of two trends in private markets. One has been around the tie-ups with insurance companies, and that's been more of a story on the private credit side of things. And the retailization, the democratization, to bringing private investment strategies to wider swaths of the industry. Now, that shows up in so many different ways, be it investment types, be it investment products, be it forms of distribution, the types of firms that are working together. I don't think we're anywhere near done, but it has really impactful business implications to the organizations that want to participate in these trends. How do they think about data? How do they think about systems? What people do they hire? What firms do they tie up with? Do you do a partnership? Do you do an acquisition? Do you want to go broad or deep or both? And there's so many ways that firms can pursue these themes, and it's not even close to crowded. There is so much investment innovation, product innovation, distribution innovation that is just absolutely remarkable to see.
What has to happen from a technology and a market infrastructure perspective to enable all of that innovation to occur?
Look, if you're going to do a couple of equity investments a quarter, you can do that on a napkin. You can do that in Excel, and that's fine. And many firms do, but it's really a question of scale. And firms need to understand where they are and where they're going and what's appropriate for the scale where they're going to be in the medium term or the long term. I don't buy enterprise software to track my Amex bill at the end of the month. It would be silly, right? But professionally, I'm in the business of enterprise software, financial software. And really, we want to talk to our clients about what are they trying to do and at what scale, and what is the appropriate way to do so. There's a lot of challenges firms have, our clients, organizations we talk to, firms that we may not work with, that they grew up in a particular niche, a public equity manager, a private equity manager, a credit organization, that they build systems and processes and organizations around the thing they do today or at the time. And what happens is, as soon as they want to branch out, they feel handcuffed by the thing they were doing. So that's fairly abstract. What does that mean in practice? You have an accounting system, and that accounting system is great for liquid products, or you're a high frequency trader trading equities and futures, and then you want to have a private equity strategy. When you design your organization around the thing you do today, you can get locked in. You can get stuck. And when you try to do the next thing, you either have to rip out the original thing or build something alongside it. There's a third way, which is what we think is really the way of the future. And you see organizations in all sorts of contexts doing this outside of financial services. Take a firm like Palantir. They're really taking a data first approach to things. Say, look, I'm always going to need to do this type of accounting because I have this type of product. But now I have this tie-up with an insurance company, and insurance companies have a very different way of doing accounting than a private fund, than a public fund, than a UCITS, than a 40 Act, et cetera. And so firms are taking a step back and saying, how do I deconstruct what I'm doing? What is an investment? Now you can jump a few steps and say, oh, well, Bloomberg shows me that this is an equity. And like, okay, that's great. IBM is in fact an equity, as is Google. But also the private holding we had pre-IPO in Uber is also an equity. And how are these things different? And so going back to first principles, having representations of things at their most granular level allows you to really, I don't want to say completely future-proof your business. And I sort of don't like the buzzword and cliche, future-proof this and that. Like you're never future-proof from everything. But if you start from a foundational principle of, let me have a representational model for the types of things I do, anything new that comes up really is a lot easier, because you're starting from a position of everything is represented as underlying data. It's not, this is my Bloomberg ticker. You start before that and you say, this is how we define an equity investment. And an equity may be public, it may be private, it may be a PIPE, it may be a secondary, it may be a convertible bond that converts into equity, and that convertible bond may be public or private. And so when you start representing things in this way, it allows you to more nimbly go after new opportunities. This wasn't really a possibility 20, 25, 30 years ago.
Why?
The technology wasn't there.
In what sense?
Really, there are a lot of tools that are now available en masse for organizations to do this. You can go to Snowflake, you can go to cloud data providers, you can hire data scientists, and you can start to build some of these things yourself in a scalable way. That comes at a cost. I mean, you're hiring engineers. These are very, very talented, top talent people with lots of opportunities. So it's a very competitive market, but there are products and frameworks that out of the gate get you started. 20 years ago, you were designing these things from scratch. You were building your own databases. You were sort of trying to do, it was incredibly difficult. Now, there are firms that are phenomenally successful that have done this. Our origin story as an organization is tied to one of these phenomenal success stories. But really what you were doing is like, all right, I'm going to do private investing. I need to buy the private investment system. And you did that and it was fine, but a system isn't data. A system needs data, and a system may produce data, but it's not itself a foundational data platform.
I want to unpack that. What exactly do you mean by that in terms of the difference between a system and data, and how those two things interact with each other? Because data, the output of data is only good as what goes into that system. So how do you think about system and data interacting with each other?
It's a great question. And this is a very new way of thinking. Last couple of years, I like to pick accounting systems. I'm a back office guy. If you want to do accounting, you need things like what transactions did I do? What price did I bought something, I sold something. When did I buy it? Why does that matter? Well, is it a long-term gain or a short-term gain? What did I buy? At what price? When did I sell it? At what price? Great, I have a P&L, maybe a resulting cash balance. And so you need certain data. What is the thing that I bought? Is there a certain tax treatment for it? When did I buy it? I need a price, a quantity, a market value, a date, I don't know, 10 fields, 20 fields. And some of these things are complex. You might need 30 fields or 50 fields. And if you're really good at accounting, you have mapped out exactly what data do I need. I'm going to push it through, and then I'm going to calculate, and I'm going to export. Here's your P&L, and here's your cash balance, and here's your receivables and balance sheet. These are complicated systems. I don't want to minimize them. We've spent millions and millions of dollars building our own. But the reality is not every question a firm may have is an accounting question. What is my exposure to XYZ lender or borrower is not fundamentally an accounting question. And so regardless of how straight through your accounting process is, your process isn't designed to answer that question. You say, well, you know what? Gee, I wasn't actually capturing that data because I don't need it for accounting. And so what winds up happening is organization, they have an accounting system, and then they have a treasury system, and then they have a portfolio monitoring system and a lending system. And you wind up with all of these systems, each with data input needs, and they each generate output, but there's no rhyme or reason to the foundational data that feeds all these systems and what to do with all the data that comes out of it. And it becomes chaos because ultimately these systems start to disagree with each other. You can't say, what is my exposure to XYZ borrower, and say, well, if I look in my accounting system, the answer is X. And if I look in my exposure system, the answer is Y. So you need to be really thoughtful about how you architect these things. So what we are seeing, what our clients are doing, what we help them to do is say, what is the data you actually care about? And often it's not enough, right? We're saying, no, but what about this? And we're like, oh yeah, I forgot about that. And so, we have thousands and thousands of data models that we help with our clients. Some of our clients don't even need to do anything with that data yet, but they might in the future. And so those are the types of things that you want to think about. How do I capture everything that's relevant that I could then feed down into current systems, future systems? And then what is the data I'm producing? What's coming out of my accounting system, risk system, exposure systems, portfolio management systems? And how do I put that in a place where I can access it independently from the system that calculates it?
I think you're getting at two really important kernels of thought. One is data silos, and two is harmonization of data. And that could be just within one strategy. Private equity, let's say with a firm, there may be silos, there may need to be harmonization of data. That probably gets more complex as you get to firms that are evolving both in terms of the strategies they offer, maybe they're acquiring firms, there's a lot of consolidation happening, and then the product structures that they're creating or launching. Maybe it's evergreen, 40 Act, interval tender offer funds, et cetera, in addition to closed-end funds. How do all those things interact?
It's such an interesting problem that shows up in so many different ways. I have a really fun example because I think people, when we can make it tangible, there's a phenomenally successful, primarily private, primarily equity investor group that has launched fund after fund very successfully, each one larger than the previous, and has a fantastic track record. I mean, Databricks, Uber, very early in many of these companies. They had a really novel strategy with their investors where they would allow them to opt in or opt out to any particular investment that the fund made. Fantastic if you are fundraising.
In a closed-end structure?
This was in a closed-end structure, yes. Very novel approach. Makes sense if you're raising capital. Like, this is great. Investors love options. Look at all this flexibility we give.
Hopefully they didn't opt out of Uber or Databricks.
The ones that did are kicking themselves. So So that's great. And they raise capital and they have their investor relations people talk, hey, we have this investment coming up. Are you in? Are you out? They create SPVs. What winds up happening is the investor calls and says, hey, how did I do in Uber? Totally reasonable question. Or how did you do in Uber on my behalf? Totally reasonable question. You want to be able to answer that. Well, it's actually a really hard question to answer because you need to know in which fund is this investor, and in those funds, which deals did they opt in or opt out to, and what funding is, Series A, B, C, et cetera, pre-IPO, post-IPO. We hold the liquid stock, but are restricted in it. But then we did a additional, and so it winds up being a very complicated question to answer if you're trying to answer it from the perspective of I'm an accountant using an accounting system, because accounting systems, for good reason, are designed to do the accounting for a fund. How did this particular entity do? But this investor cuts across many entities.
So this is unlike many accounting systems, which are top down. This was really bottoms up.
And so if you represent the investor, the SPV, the investment, the series of investment, and you model them with a data model that allows you to, at the lowest level of granularity, identify this is Series A, this is Series B. It's still the same equity, Uber, Databricks, but it's a different series. And it associates with these funds and associates with these SPVs and associates with these investors. And here are the output of the accounting system that did the tax lot accounting. You could then answer the question in a few minutes that previously, if you don't take this approach by managing your data, would take your accountants a few weeks to just manually try and figure it out. And it's not that the organization didn't have technology. They're brilliant technology investors. They appreciate the value of technology, but it's that there wasn't the right design for this type of problem. And look, I wish I could say that 2 years before they launched this novel strategy, I knew that this was the trend. I can't. I have no idea what's coming next. What I know is that by taking a data-first approach to things, it allows you to nimbly embrace these types of opportunities without stressing too much. Am I going to actually be able to handle it on the back end?
Brings up an interesting point. When are funds thinking about how they need to architect their systems, particularly around post-investment, that enable them to have the flexibility to launch new products or new structures, manage and track and report properly? Is there a time when it's best for funds to think about that? Is there a size and scale? I imagine the bigger they get, the harder that is to implement, because you have to then take tech debt and operational debt and augment it or change where it fits and how it sits within the organization. So how are firms approaching when, how, and where they add software solutions like Arcesium, or just more generally think about this from a technology perspective?
So the best time to do it is before you launch anything. The next best time to do it is yesterday. The next best time is today. We live in the real world. Our clients are successful, and they're successful not strictly because they made a smart architectural decision. I think the way our clients have grown up, they've been front office led, investment led. And that has allowed them to build these successful businesses that have allowed them to hire thoughtful technology leaders who think about problems like this. And we're very fortunate to work with those types of leaders. There's generally some inflection point that managers approach that causes them to think about this in practical terms as opposed to abstract terms. Yes, it would have been great to have done this beautiful, magical thing when we launched. We live in the real world. What they're typically doing is saying, what is the logical breakpoint? And often what we're seeing is it's a new strategy, it's a new geography, it's a new asset class, it's a new distribution channel, it's a new partnership. And they're smart enough to know that, okay, we're going to be doing this. what do we need to do to get our house in order in advance? And so if you're a publicly traded private markets, multi-strategy organization, you've been phenomenally successful. You have teams of brilliant technologists. You can tackle this problem. And really, they're trying to get ahead of it, which is, okay, we know that, and there's different models, some think private credit, the illiquidity is a feature. Some think illiquidity is a bug. That's fine. But that philosophy will bring you on a path of, I want to invest in something that will allow me to bring my products to wider, democratized distribution channels at scale. What might that look like? Well, today I have a couple of SMAs. What will my business look like if I want to run 1,000 SMAs? And so the smart businesses are thinking today, the business people, the technologists, the operations, accounting are thinking together, okay, if we are going down this route of retail, smaller, democratized SMAs, what do we need to do? Others are saying, look, we're going to do this mega tie-up with an insurance company. Maybe it's M&A. What does that look like? And they go down different paths. Now, the answer is often it's a data story, but how that actually gets architected and implemented can be dramatically different.
How should firms approach the question of how they should architect their technology systems and capture data in those examples that you mentioned, like creating evergreen funds to take in more investors, or partnering with or buying insurance companies like Apollo has done with Athene, or KKR has done with Global Atlantic, or Blue Owl's done with Kuvar?
Yeah, it really gets down to understanding the data that is going to be important. And so using those two examples, I think are potentially opposite ends of the spectrum. An insurance company is going to care a lot about things as it relates to regulation. Insurance, highly regulated, so asset liability matching and holdings and NAIC ratings and specialty accounting methodologies, which will differ in the US and Europe. Do I need to do something in Bermuda? Is it a reinsurance? So that's going to be the data. And so it's going to have more of like a ALM regulatory look and feel to it. If you're going the mass distribution route, it's going to be, who are my investors and who are my distribution channels and what are my reporting, I'm not going to say requirements, but what do investors expect to see and what look and feel? Will Morgan Stanley or UBS have different requirements because we're doing work on behalf of their clients? It's still a data story, but it's a very different approach in terms of like, all right, now we're going to get our hands dirty. Sort of silly to say getting your hands dirty with data, but we're still sitting in front of computers in air-conditioned rooms. But when you dig into that data, where you're spending your time will matter a lot depending on the strategy you're trying to pursue.
What's interesting about what you're talking about as well is you mentioned that many of these firms have become successful because they have good investment organizations. And that's certainly true. But it also feels like, particularly for larger firms, the technology function, and I had the CTO of Blackstone, John Stecker, who I'm sure you know, given the firm's relationship with Blackstone, on the podcast. And John is really a strategic CTO.
Yes.
And just like a strategic CFO actually helps the business on the finance side with any company, it feels like there's a strategic CTO who actually can help the business. And the technology and capture of data, particularly post-trade, also pre-trade as well, in terms of how you funnel information to investment teams, how it helps them analyze and source investments, and then ultimately underwrite investments. And then post-trade helps them post-mortem effectively understand where there's good investments and then do a good job reporting to investors. You've talked about this as well, how it can actually, reporting can be a strategic advantage because it's really like, these are long-term customers. If you serve them well, then you'll probably keep those customers as LPs. So there's really this strategic role that technology can play. How are firms thinking about that element as they either start their asset management business or they continue to build it, where technology is actually a strategic role, not just a operational role.
Spot on. What we often see is when an organization launches their first technology hire, they name them CTO, but the bulk of the job is, literally getting on your hands and knees and plugging the mouse into the computer. And many of CTOs will laugh and they appreciate that experience, and they started their careers doing that. That's not the CTO of a firm like a Blackstone or an Apollo or a KKR, these large successful organizations. These are strategic partners, advisors to the business, both in terms of how to set up and build the operational infrastructure of the organization itself, but many of them are quizzed as experts on the technology for the investment committees. And I think it's a testament to the respect that they have within their organizations of having this. I think when we take a step back, what's really important to the business, and there's a paradox with data, which is that when you're making a decision, whether it's an investment decision or you're a global leader of a company, a country looking at geopolitics, when your window for decision making and the opportunity to make the broadest possible set of decisions is wide, you actually have the least amount of data. And by the time you have enough data, the 95, 99% of data you would need, the margin for maneuvering has dramatically shrunk. And so there's an opportunity for taking action, taking bold action, making a new investment. If you're a world leader operating in the world of global affairs, there's a trade-off between waiting until you have complete information and operating when you have wide latitude to be a first mover or to be able to shape the board. That's a fundamental paradox. And that's true with what we see with our clients. The way to get a competitive advantage, and we see this, is to say, okay, how do I get the information faster? Now, if you're compiling PDFs, if you're doing silly things, if you're like, ooh, we have this data, but I don't have a way to use it, you're already at a disadvantage. And so if you want to allow leadership in your organization to move quickly, to make those big types of decisions and be able to operate when the opportunity to do so is wide and you have the latitude to make a big decision, to shape the way things play out, you want to be an early mover. I'm not saying wing it. I'm not saying go by gut feel. Gut feel's a thing. But if you're able to more quickly make use of the data you already have available to you, you're already light years ahead of what your competitors are doing.
Given all the innovation in technology and now with AI as well, does all of this benefit larger firms who presumably have more data or smaller firms?
I think that there's a barbell. You have large firms and small firms, and the ones in the middle get stuck. And I think the large firms will have the benefit of breadth and big budgets, right? I mean, they have armies of people, they can be smart, they can be strategic, and the small firms can be nimble and quick and capitalize on niche opportunities. I think it's hard to be in the middle because you won't be able to move as quickly as a smaller firm. You probably have higher expectations from your stakeholders, whoever they may be, about what you're doing that may hold you back a bit, but you're never going to be able to compete on those things with some of the largest firms. And so I think people need to figure out, where do they want to compete? Do they want to compete in the mega, or do they want to be a niche specialist? And how do you grow? That's often a real source of self-reflection. I have a successful niche business. Do I want to go compete with the top 5, 10 organizations, or do I stay here and really double down?
Can technology give the niche specialists the advantage that can enable them to grow and maybe become a scaled specialist?
Without question. but technology is an enabler. And so you still have all of the business challenges. Do I have the right talent? I can give you a beautifully designed, scalable data mesh. Will your investment talent know what insights to look for? And so, yes, technology, if you can get the other things right, will allow you to scale your business in particular ways, but it's not going to replace the entrepreneurial zeal, the business acumen that allows these firms to be successful.
What advice would you give to the firms that are in the middle on how to implement technology to augment their business, change their business, give themselves some sort of competitive advantage?
Technology budgets grow over time, and leaders, myself included, sometimes look at this and like, what am I spending? What am I getting? There are a lot of, you have your Zoom bill and your Microsoft bill and all of these things. So you think you're spending a lot on technology and you're like, well, what did I get? Well, you got mobile phones and your Bloomberg machine and market data. Like there's a lot of things that go in there. What I advise clients, firms I speak with is don't try to dabble in 50 things. Don't spread yourself thin, because if you're a chief technology officer and at the end of the year, you've made like 50 small investments, your partners at the firm are going to say, well, what happened? You're like, well, it's impossible to measure success if you've made 50 watered down things. And maybe there's an improvement, maybe not, but it's impossible to show what's successful. I would argue do one big thing. So don't do 50 small things, do one big thing and show that success, like really focus on what that one thing is. And you'll build that credibility to then go and do more. You'll show people the value, because otherwise it's wasted.
Brings up a really interesting point, because I feel like in private markets infrastructure and technology, we're at this point where there's a number of innovations and the market's growing such that there are now a number of point solutions. We've invested in a number of these. We have a view that there's going to be really interesting point solutions that get built. There's also going to be end-to-end platforms that get built and either partner with or build or buy a lot of these point solutions. How do you think about what you just said with this explosion of point solutions and technology innovation in private markets technology? And how should the CTOs and Arcesium as a business think about that evolution as to where all these point solutions fit in and what it means for the life cycle of an investment and the market structure within private markets?
Yeah. There is this inherent tension between platforms and point solutions. And look, I get this as a business operator myself. Why do we use Zoom and Slack? And why can't we just use Microsoft for everything? And my users won't let me. And I happen to love the tools that we use. And I hope my wife doesn't listen. She works for Microsoft. We love Microsoft. But there is this inherent tension between point solutions and platforms. And I don't think it's one or the other. People will skew one way or skew another. We're never getting away from point solutions. We've got some point solutions we love. But I think you need to think about it, if you're a strategic leader, a technology leader, as what is the true cost of the point solutions? It's not the subscription. We think about this when we think about our AI strategy. If all of your information is roughly in one place, you can start to learn and plug into LLMs and really start to gain some scale out of it. If your meeting transcripts are in Zoom and your Slack AI is in Slack, and you have all of these different things, it becomes unbelievably difficult to try and have an AI strategy, for example. And so you can either take a platform approach and you say, look, I may be compromising on the fringe of this feature or that feature, but what is the value of having all of the data in one place? Because now AI is the current high. How long have we been going? We only started talking about AI now, but when you think about platforms versus point solution, this is a big consideration. Now, the other way to approach that goes back to what we were talking about earlier, which is to say, look, have all the point solutions in the world that you want and just abstract the data away from the point solutions. So if all of your data is up front and then you feed it through and then you pull it all out and there's sort of a sandwich of here's all the data we need to feed all of our point systems, and here's all the data that comes out, and here it is in a data lake over here. That's useful. Now that doesn't work with Zoom and Slack. It's different types of data, but investment data, it's another way to think about the problem.
You said something really interesting there, which was the true cost of a technology solution. What do you mean by that?
Yeah, so this matters more at scale. Like if you're, a smaller organization, you could sort of overlook this cost. But the more point solutions you have, you wind up with this web of communication. And what I mean by that is, you have two systems, you have 2 points of integrations. If you have 3 systems and you're integrating each of them, now you have multiple, and that grows exponentially. And so now what you wind up having is a huge team of technologists whose job it is to plumb all these systems together and to get the plunger when something gets gummed up in the pipes that plumb all these systems together. And then you wind up with the operational teams that have to keep them reconciled. Going back to the example earlier, what is my exposure to XYZ borrower? Well, your risk system and your accounting system can't give you a different answer. And so now you spend your life on pipes and plumbing and maintaining all of these very bespoke integrations between different systems that weren't designed to talk to each other, and then operations and accounting staff to reconcile them all so that you can actually trust the data. That's actually the biggest, it's not the license, it's not the server, it's the cost of keeping all of these systems, or trying to keep all of these systems actually in sync. Then system A is time for an upgrade, system B is this. How does that change? Oh, this system, they changed their API, their SDK has changed. You're just constantly on a hamster wheel of trying to keep these things updated, integrated, talking to each other so that your investment professionals can actually rely on what's coming out of them.
And then without maybe realizing it, you create more operational overload and challenges for the team. Yeah, and more risk too, because there's more points of presence to have to deal with and all of that. How does Arcesium fit into all of this?
So we have two technology platforms, and we sometimes work with them together, or sometimes they operate independently, depending on what our clients are looking to accomplish. One of them we think about as an operational system. Think accounting and treasury and collateral and financing, and it's where people go to do their work. I'm an accountant. I need to check my P&L. I need to do some tax work. These are very specialized tools for doing. I need to calculate the waterfall and understand my investor capital balance, right? It's where the work happens. Within that platform, we really think about eliminating all of these integration points. It's one platform. And so you don't need to explain to 10 different places what a wire transfer is. You don't need to explain what a capital call is or a waterfall is. All of the various components understand it and talk to each other, and it works automatically. So that's great. It sort of eliminates the point solutions. Our other platform is, I don't want to say work doesn't happen there, but it's more generic data. We actually don't care what system needs the data or produces the data. It helps our clients capture, normalize, store, govern. Where did this data come from? Is a super common question. Very hard question to answer in most. Gee, I don't know. It came out of the accounting system. Well, where did the accounting system get it? So things like data governance, data lineage, these are technical CTOs will say, yeah, of course, this is obvious, but business people, they just want it to work, but there's a tremendous amount that goes into it just working.
It's a really important concept, because I think in public markets, the market structure has electronified. You're in prime brokerage, so you can appreciate this. I started my career on the trading floor. Actually, also at Goldman, I was in the PSI team, so a little different side. But you see how the market structure changes, particularly equities, fixed income, derivatives. Now, private markets is still not entirely electronified, and I think there are good reasons for why that's the case. But how do we get to a place where private markets, for the stakeholders who are just using it, where they can just say, this just works?
Yeah. It comes back to how you represent the investment. I think so there's two ways for something to just work. You can force it to its lowest common denominator, so it's simple, but you eliminate a tremendous amount of flexibility. We see this in the markets, right? Bonds are great, but they're common, and they have a QSIP, and you can look on a Bloomberg machine or a Refinitiv, you can get it. But the reason they work is because they're very simple. It's structured, it's a commodity, and you get a lot of scale when it's a commodity. When you go to the gas station, you don't want, 30 different kinds of gas. Like, you just want to put gas in your car. But if you're building a specialist Formula One race car, you actually may want to play around. You may want to put jet fuel in it. Private markets are growing because there's demand for more customized exposures and risks, and asset-based financing is a great example of this. And so how do you make that just work? Well, you can water it down and make it a bond, in which case, well, you sort of defeat the purpose of it. Or you can you can lean in and say, this is more complicated it doesn't need to be complicated, but like, we're customizing this for a reason. It's not customization for the sake of customization. There's important risk reward trade-offs and covenants. Like, we're designing this in a very specific way for a very specific objective. The way you do that and make it feel simple is to say, look, I know I'm not going to plug into Bloomberg and get the answer. Maybe it goes that way, and Bloomberg's a huge player. But really, what do you do today? It's, well, how do I make it look as if it were a bond? Well, a bond has a coupon and a tenor and an accrual methodology, and there's probably 108 things that matter. There's probably 250 things that matter on a piece of private debt. How do I model them? How do I break it down in its component pieces? And then when I talk to the investment team, well, here's what I care about in covenant monitoring, and here's what I care about in exposure monitoring. And it allows you to do that quickly. And then when you start to move, real estate lending, you could say, what's my exposure to Kohl's as a tenant? It's like, I didn't think of that question, but it's pretty easy to answer when you've broken these things down into their component pieces. That's what people can do today, and that's what they are doing today. Look, I think there's some industry things that are interesting. Bloomberg, FactSet, big data companies are all doing it. Big data as in those types of firms, not big data as in Google, are pursuing industry-wide initiatives. I don't know, maybe we put it all on the blockchain. There's no obvious thing that's going to come out as the industry standard. And I don't think smart people want to wait for that.
What do you think is the next evolution in software innovation for private markets? And maybe asked a slightly different way, but there's things that you're able to do now with technology, and there's things that you're still not able to do with technology. If you could wave your magic wand, what would be the next piece of technology that would make and create a step function change in how people are able to do their business in private markets?
So if you're waving your magic wand, it's really AI that is going to be the step function change in how these organizations operate. There's a lot of groundwork that needs to be laid in order for that to happen, but a lot of these specialty point solutions may be mooted because once you have the foundational data layers, you can plug in LLMs, start asking questions and constructing things, both asking plain English questions, but also your software developers. You can develop software so much faster with smart AI that, who knows, you may not need to buy specialist point solutions anymore. And I think that's fascinating. And it's both an amazing opportunity that we're excited about, a little nervous. Well, what does that mean? I mean, we employ thousands of engineers we're in the early days, but we're seeing dramatic efficiency gains, not to the point where entire jobs get replaced. I don't think that's a short-term thing, at least for us, but in the amount of toil, the low-end work that's just fundamental to the job of software engineering. It's a pain. You have to do it. It's the equivalent of your expense report and your time cards. But that we're seeing tremendous uplift in efficiencies, and we think our clients will see that as well.
What's the most impactful and actionable advice that you can give asset managers about how to use AI?
Be careful with vibe coding. It's fun. You're running serious businesses, often regulated. We've hired engineers from the likes of Facebook and site reliability engineers and the like. And it's one thing if you're Facebook and a user presses the like button and it doesn't go somewhere, it fails to like. It's another thing in financial markets when you push the button for a $500 million wire transfer to move and it doesn't go anywhere. So
not good vibes.
Not good vibes. So be careful with vibe coding. It's fun. So but in all seriousness, run your experiments, be thoughtful about it, but have proper technologists to oversee before you have it override production code.
That's a fascinating point. I think what an interesting way to wrap things up, because I think so important how firms approach technology and how they use it, how they implement it, and when they think about it too. I think that's the other aspect that you honed in on, is the time at which firms actually think about using technology really matters.
Indeed.
Well, David, this is a fascinating conversation. Thanks so much for coming on the show.
Thanks for having me.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going